رجاء elle est belle ta photo. وصباح انت بتجنن كمان. We'll wait for a few more minutes. Tu vas bien? Super. صباح كيفك؟ صباح سكتي. Merci. Noël is on board. Okay, we give it a few more minutes. Let me get some of the slides, share screen.
Bonjour, Constantin. This is Emmanuel.
Hi, Emmanuel. How are you?
Right, thank you.
It's good to hear your voice.
Yeah.
Emmanuel, you know I'm doing a similar one on Monday. On Monday, Abidjan, 11 o'clock for a Stanford Seed Company. So it's Patricia who asked me. So I sent you an invitation. Did you get it?
Yeah. Is it 11 o'clock Beirut time or?
No,
Abidjan?
it's 11 o'clock Accra time. So Accra, Abidjan time. So we'll go through it. I'm going to conduct it in French. She asked me to do it in French, but I know your French is excellent, Emmanuel. Emmanuel, it would be great since I have you on board. It might be good for you to, because you've gone through so many social enterprises in terms of screening, is that for you to spend 5 or 10 minutes to describe a bit what are the criteria that you and the team have been using for the past 5 years in screening. You've screened hundreds of social enterprises. Can I ask you to do this?
Wow, Constantin.
No, but look, you have 4 full days to only 5 minutes.
Oh my goodness.
Okay, I count on you.
I don't have to. I don't want to take time from today's program because there are.
Don't worry, because in Lebanon we always start a few minutes late. So it's. But anyway, reflect on it, and I'll be happy to have you there.
Okay.
Thank you.
Salut, Constantin.
Hi. How are you?
Fine, and you?
Yes, the gentleman I was talking to is the head of Stanford Seed for West Africa. So we've been, our friendship lasted more than 5 years now. So first time I came out in Ghana. So this was in March 2015. So so a lot of memories by hearing his voice.
How did he reach? How did he get the invitation?
I send it to him. Yeah, because we're doing a similar one. It would be a bit different. This one is on more specific, but we'll be doing a similar one for the Stanford Seed Company in West Africa on Monday. So this is very good. Tell me, Sabah, do you have the screen, the slides, or not yet?
Yes, I see the slides.
Okay, very good, excellent. Tell me, when you see the slide, do you also see on the right, do you see my face and the name of others? Like, so I need to remove this one. Okay, so you have, and I need to put myself into, okay, and then put myself. Now it's better?
Yes, now you are in a presentation mode, and this is much better. But remember last time you were in the presentation mode and you couldn't get out of it. Try it if you want.
Yeah. No, I'll try it. Okay, I know what to do now. I have to click here and then click again. Yes, very good. Okay, excellent. We give it just a couple of other minutes for other people to join in, and then we're going to start. Any questions for those who have been, who are now on the call? We have 12 on the call. Any questions on what we covered last time in terms of the due diligence and term sheet negotiation?
Constantin, hi, this is Salwa speaking. I was expecting to get your presentation before this call.
Yes,
actually.
no, you're absolutely, Salwa, it's a good
point. In order
point.
to study the term sheet with the data in front of it. So
yeah,
I hope you will share them after.
Yes, no, we will. Salwa, it's a good point. And I tell you frankly, we did it on purpose. So it's not a miss. And the reason why we did it is because we realized that if you don't have a carrot, people don't fill in the survey. So what we do is, and it's not Joelle, it's Sheila who asked me. She said, "Constantin, don't release it." I would release it once they fill the survey. So there's going to be a survey coming your way that will cover the two. Basically the two workshop webinar that we have, and then you will receive it. So you will receive the presentation. You will also receive the templates you should have received. Did you receive the term sheet templates?
Yes, the term sheet I have, but I wanted to review it with your slides in front, so to identify the problems, and that was not possible. I took some notes, but not enough, unfortunately.
Okay, very good. No, this is good. It's a good point. It's done on purpose, and you will receive the slide set. I'm going to actually share with you a couple of others, because we covered both the due diligence and we covered also the term sheet. So I will share with you what is the format that we use, typical format that any business angel would use for doing the due diligence. And this will be the one that we have used for Cedar. I'll check if Hassan is on board. Hassan always,
yes, Constantin, I'm on board.
Excellent.
Hello, how are you?
So Hassan, I'm going to take you a bit by surprise as usual. So in about half an hour, I will ask you just to share, since you have been leading the due diligence for Clean2O, just to share some key learning points in terms of the due diligence process on it, since you are leading it. So you have just to put 3 or 4 bullet points. You have half an hour to prepare for it. It would be great to share it with the team. Is this okay with you, Hassan?
That's fine. Did I tell you I have an appointment, another one in half an hour, or? No, that's fine.
Yeah,
that's
very
fine.
Good. Excellent. Thank you, Hassan. Okay, very good. Let's start. We have 20 already. I know that we're going to have a few more coming on board. So this is what we have shared last time. So this is the different phases. We went through different investment readiness. We focused on due diligence. We focused on term sheet. We didn't have the time to go through a due diligence format. So I will share with you a blank format that we use. I'll share with you a completed one that we also use. And I didn't share a term sheet. There we're going to go through the term sheet. It's actually a term sheet that Emmanuel is on the call. So it's a term sheet that dates back 5 years ago. Emmanuel came to me and said, "Constantin, what do you think?" I said, "It's an excellent case study. Let's use it." And I've been using it repeatedly as I deliver these workshops on term sheet negotiation. It contains all the good elements in a term sheet, and it contains some of the red flags in a term sheet. So I will be sharing those with you, and we'll have a discussion on it. Hassan will present his perspective on the due diligence that we carried. We took about 6 weeks. He was extremely involved in the process. He also presented the finding last week to the Cedar Investment Committee, and hopefully the decision will come up over the next few days on it. I also asked Ziad, who will be joining us around 10 o'clock, who has gone through 2 rounds of term sheet negotiation, and he felt the gains and the pains of what a term sheet could be, and if he had to do it again, how he would do it differently. So I think it's important that you hear it from people who carry due diligence and from people who have negotiated in terms of term sheets. So it's going to be interactive. It won't be long. You will see that an hour and a half will go very quickly in this process, and we were supposed to have Flat 6 Lab. Unfortunately, they had a meeting last minute, so they couldn't make it. Let me check your chat here. I'm going to go through your list. So good morning, Constantin. Good morning, all. This is clear. If I can't, can you please give us a brief summary from the last session? I will do this right away. Investment, and Sabah responded. Very good. But I'll go through it. So these were the points that we have covered for the last session. I'm going to show the one slide that summarizes it all. It's this slide. So this is the important slide. It's a heavy slide, but every word of it is an important slide. So this is the stages that any investor, being it a business angel, being it a business angels fund, being it a VC fund, being it an investment private equity fund, or being it a company that is investing in different transactions. And this could be investing in debt, or it could be investing in equity. It could be investing for $500,000. It could be investing for $50 million. The process is the same. So these are the 5 phases that you have. So on one side, these are the 5. So we go from screening. This is, you screen and you decide yeah or no we want to go. You go into evaluation. So this is more detail. The pre-negotiation is where you have the term sheets. So this is where the term sheet comes in place. The 4th phase is a due diligence. So once you've done the term sheet, you want to validate whether the information that you have is real information and whether these assumptions are real assumptions. So this is the due diligence process. And you will have the closing, which is a shareholder agreement. And you have the post-closing, which is what do we do once we have invested. For instance, in the case of Clean 2.0, in case the investment committee decide to go ahead, Ghassan will be not only the one who have been leading the due diligence, but he has the option, if he decides to accept, to be the deal manager. So this is, and the deal manager is the insurance policy. So once we have made the transactions, once we've signed the shareholder agreement, once we've invested the money, we have always a person that is following up and sitting down on the board and representing the interest of all the other shareholders in this transaction. So this is part, if you want, not of the closing, but of the post-closing that we have. So these are the 5 phases. This is typical phases. Now, the key activities are also clear. In the screening, it's a first pass. You get a sense. Is this something that is interesting or not interesting? And we shared with you the template, which is the screening scorecard, in order for you to get a first sense. And normally, if you are part of a business angel fund, we get it, and then we come up quickly and we decide go, no go. Do we go further or not? Then when we go further, we then spend more time understanding. So this is not a few days, this is 2 to 4 weeks, is to trying to do the valuation, understand a bit more depths in terms of the business model, understand the team, understand the players, understand the competitors. And here we develop what we call an investment thesis. So what I'll share with you is a template for an investment thesis that we use in Cedar. So this is blank. We have now Ghassan, who was appointed, took this investment thesis and filled it out. I will not share this. This is confidential for Cedar, but this is the typical, but this is filled by whoever is leading the due diligence team, with, of course, contribution coming from the different players. It's not only one person who is present in the due diligence. We typically have 3 or 4 people. In our case, I think we were, Ghassan was leading, I was present, we have Toufi also present, and we have a 4th person coming with different background. It could be sales and marketing, somebody else would be on finance, somebody else would be on strategy. So you have people coming from different backgrounds to be able to ask different questions and this we come up with the investment thesis. Once we've done the investment thesis, then we go into the term sheet negotiation. So the term sheet, as you will see, as you all have received, is a fairly, you feel that it's a legal document. It's actually not only a legal document. It's a business document with very precise terms, with very precise financials, with very precise valuations. So you need to be on top of it. And the best way to be on top of it is by going through this process several times. The more you go through it, the more you make mistakes, the more you learn from your mistakes, the better you're going to be at it. So this is what we'll be discussing today. The due diligence is related, if you want, to the evaluation, is that you take what we've done in the evaluation and then you go in more detail. So you do it a second round. Is that making sure, is this correct? Are these assumptions realistic? Is the team complete? Do we need to have other people on the advisory team? So you go this and then you come up after this with a full due diligence report that will validate your valuation. When we've done the valuation back in phase 2 on the evaluation side, with the due diligence, you then check and say, this valuation, let's say, doesn't make sense. And it happened in our case. And Ghassan will brief you. Initially, the valuation range which came out was about 25 to 30% more than what, and we came up with, after the due diligence, with a revised valuation, which was about 25 to 30% lower than what was initially asked for. But the only way to go there is to go through the due diligence process, okay? So this is and then the closing is the shareholder agreement. This is where you do the shareholder, this is where you invest the money, this is where you close the transaction, and this is where you appoint someone to represent you on the board of the company and to represent the interest of the shareholders. So for each of these 5 phases, you have typical time frame, take it plus or minus 20%, 30%, it doesn't matter. Every situation is going to be different. It could be as short as 3 months or 4 months. So we hope, for instance, when we first met with Clean2O, Hassan and I and Tufik, it was about maybe 2 months ago for the Cedar thing, 2 months and a half ago. And if we are all lucky, within if this is fine, within normally 2, maximum 4 weeks, if the decision is positive. So the process would have been a short one. It would have been about 3, maximum 4 months. But it could be from 4 months. It could be some of the companies go for 9 months, go for 12 months. So the timing, take it with a grain of salt and adapt it to the situation. What's important are the deliverables. So you need to have those templates. You need to know what is the screening scorecard. You need to know what is the non-disclosure agreement, the NDA, and how does it look like. You need to know what is the investment thesis. You need to know what is the valuation model. You need to know how is structured the term sheet. You also need to know how do we structure a due diligence report, and you need to know what a shareholder agreement is. Now, you don't need to be experts in those, but you need to get a good sense of where they are. Okay, so this is a summary, Tony, of what we have covered last time. We went through all the details of it. I shared with you a blog, so this is the article that I took some of the slides on the term sheet and on the due diligence and shared with you some. And this was, I think, shared. It's on the Berytech website. So this is shared. So I'm going to stop here. And before going into the detail of the due diligence and going the detail of the term sheet in terms of real cases, any questions on this slide? It's a complete slide, and it's a slide that you need. Let me check the questions, chat. Thank you, Constantin. Okay, so any questions? So if you have questions, please write it on the Zoom chat. If there is no questions, I'm going to dive. I give you 5 seconds. Okay, no question. Okay, let's. I'm going to now go back. Escape. How do I escape? Okay, here it is. And let me share. Let me share. New share. Okay, new share. And then I'm going to show you, what do I show you now? Whiteboard, heavy home, some others. Okay, let me try again. Just bear with me for a second. Okay. We have, I mean, the slides, financials, so which is the one that I have. Open it, PowerPoint. Okay. Okay, here it is. Okay, so if I want to share this one, let's see there. Go back, new share. How come it doesn't show it? Okay, all right, no problem. Okay, I'm going to look at the term sheet one. So I'll start with the term sheet on this one. Sabah, I'm using you again. Now, do you have the term sheet? Is this clear? Is it on the screen? Okay, very good. Thank you. Okay, so we go through a term sheet. This is a real life term sheet, June 24th, 2015. This is with between a company that was part of Stanford Seed and another VC that year. This is companies that we have. I'm going to go through it and first look at the structure of the term sheet. So I'm going to have the different categories, and this is a typical term sheet. So you will have very similar sort of term sheet coming in. It might vary if it's straight debt, if it's convertible debt, if it's equity. This one has 2 interesting components. It has a convertible debt component and it has an equity component. So there is no grants on this. But even grants will have a term sheet. So I mentioned to you that we have won this big project that will be providing grants to about 50 social enterprises across the region in Lebanon and across the region. Now these grants will have a term sheet because we would link the payment of the grants based on milestones that the company needs to deliver upon. So this is the best way to go about grants. Don't give them free money up front. Agree on what are the milestones, agree on what are the metrics, and then go ahead and provide the grants based on the accomplishment and the meeting of these milestones. So let me start with there is the introduction. So this is who is what. These are the two companies. This is fairly clear. Okay, the preliminary term sheet is not a commitment to invest. It is terms that are subject to completion of financial, environmental, legal, and commercial due diligence and documentation satisfactory to the investor. So this is not binding. Bearing in mind, non-binding, the only binding document is going to be the shareholder agreement once we finish it. So this is here as a preliminary, it's subject for negotiation. The only binding thing that you will find here is that the validity of the term sheet. So how long can the investor ask for exclusivity? And this is one of the topics that will be discussed during this term sheet. So here what we have, but this is non-binding. So let's start with the first one, the investment. So what is the investment? $3 million. How is this investment? The investment is going to be two ways. One, he said, by the issuance by the company of common shares. So this is an equity deal, and convertible redeemable preference share. So this is what we call a convertible debt. Now there is some legal jargon, but what we're saying here is $3 million. The $3 million, $1 million is going to be in convertible debt, and $2 million will be in equity. So we have the combination of the two, which you will see in a number of companies. Now, why do you see it? You see it because you prefer, it's better for the interest of the company and for the interest of the investor to start with a convertible debt. Why? Because they build up their business model, they build up the scalability, they increase the valuation, and then we go into equity. So this is much better for you in terms of protecting your interest and protecting your dilution. So I would strongly encourage you, when you have, start always with the straight debt or convertible debts. There are pluses and minuses for convertible debt versus straight debt, and then shift to equity later on. Okay, so this is the investments. So we have described it. We're talking $3 million on it. Use, what are they going to use? In every single term sheet, we need to specify the use. So if it's here, so we want to know. So for instance, here is the extraction plan, repayment of existing debt, completion of civil work for laboratory and offices. You will need to specify. Now, as an investor, I will always go back and say, okay, is this really the best investor for your extraction plan? Show me the feasibility study, show me your financial returns. So this is what you have, and this will always be to validate whether this investment is the right investment for the company. So we're not only negotiating the term sheet, we're also reviewing and will be reviewing technical and financial feasibility for it. So keep this in mind, use of the proceed, and spend time to know as an investor whether this is the right proceed, yes or no. So this is quite important. Now let's go back to, let's move down. So move down, we have here two. We have one, as we say, $2 million will go into equity. So this is the purchasing of shares, and he specifies right away that $2 million, and it represents 50% of the share of the capital. So he's setting the valuation of the company now. He's setting it now. So although I would have preferred that this is done afterwards, after we invest the convertible debt so that the valuation would increase, but he's setting the value of the company today at $4 million. So pre-money, $2 million. He wants to invest $2 million. So and he wants to get 50% share. So means that the total valuation of the company is $4 million. So he's stating it in the term sheet on it. He's also stating the convertible debt. So he's saying, I'm come up with a convertible debt. The convertible debt has a face value. I'm not going to criticize now. I'm going to go through it, make sure you all understand, and then we will go and deciding what is working and what is not working for it, because you have great lessons from this term sheet. So the convertible debt, he's saying $1 million. The face value is $1 million. We will get a convertible redeemable preference share that he has, a convertible debt. He's asking for a coupon. So since it's a debt, he's asking for a coupon of 11.5%. We will discuss later on whether this is the right percentage or not. So the coupon will always be mentioned in convertible debt. He will, the tenure that we have to be paid, the convertible will mature, so that is the term, 5 years, so this is clear. He's also mentioning, interestingly enough, what he called the redemption amount. He's saying the redemption amount is how much you will have to pay at the end of the 5th year. And here he's not he's saying 2.5 times the face value. So this is, if you remember the previous one, I mentioned liquidation preferences. This is part of liquidation preferences. So he's asking for an interest payment of 11.5% per year on the amount. So this is the amount of $1 million. And he's also asking here a redemption amount of 2.5 times the face value at the end of the 5th year. So this will be after the 5th year. So this is about $2.5 million. So the real return is actually not 11.5%. The real return is 1 million upfront. This is if you do your cash flow, you have 11.5% in interest over a period of 5 years. And at the end of it, you have 2.5 million that needs to be paid back. Now, I don't want to criticize again. I want to state it so that you understand what it is. And then we will go and we'll hammer this, this thing on it. Okay, so this is the convertible debt that he had. He says when the payments are due on a quarterly basis. He says when are the cases of default. You will see whether there are cases of default. These are fairly standard. I won't spend time. I'm going to spend time on the one that are quite important. Now on this page here is that he is giving, since it's a convertible debt, so he stated how much is going to charge interest. He stated how much is going to pay you upfront. He stated how much he wants to get at the end of the term. He's also stating the convertibility. So he says he will convert. The right can be, so this is the right of conversion, can be exercised partially or wholly on the notes of at the investment description at a coupon payment date. The right will be exercised at a ratio derived from the valuation of the company based on what? Remember here the valuation, based on 4 times EBITDA. So this is multiple, so 4 times EBITDA is the operating profit before interest, before taxation, before depreciation, before amortization. So this is typical. The 4 times is very low. Typically, when we look at it, we could look at 8 times, 10 times, we could look at even 15 times EBITDA. If you remember with the multiple, when we look at multiples of companies, if we don't have scalability, 1 to 2 times in terms of revenue here, and it could go to 5, 6, or 7 times revenue when you prove scalability. Here, very conservative, 4 times EBITDA, and the book value. The book value is the most conservative value ever in a company. So basically, it takes your balance sheet, it takes your assets, deduct your liabilities, and it's your basically your shareholder agreement. So for those of you who are not familiar, happy to go in more detail on a one-to-one basis, but I take it that you know what a balance sheet is. And every company has a balance sheet. They have to, tax-wise, they have to do it. So what he's saying I'm going to convert at the average of 2 very low value, at the 4 times your EBITDA, average EBITDA over a 3-year period, and your EBITDA probably could be negative. You know, the 1st year or the 2nd year, it could be even negative for the 3rd year. So this means that this is 0 at this point, and the average with the book value. The book value normally is always positive unless you have very high debt and you wrote off a lot of your assets, but the book value is extremely low. So what he means here is that he has the right to convert at any time at the average of these 2 values, which are very low values. And normally you would specify in the convertibility, you normally specify that the convertibility is at the value at the time of convertibility, and you never get convertibility before at least 2 to 3 years to be able to allow the company to generate the revenue, to generate scalability, to prove the model is working, to it. So this is, I'm going to go through it again. I'm explaining it, and then we will go and criticize it. So what we have, so we explain convertibility. Now, conditions precedent to an investment by the investor. Now, this is important, and you will see it in all term sheets. So this will be the typical documents. Now, you have to look at it because you, as the company, you need to make sure that and this is typical. So this is so it's very clear, and this is. And you need to prepare the document. You need to do the homework with your auditors, with your lawyer, to have all these documents. So they're mentioning about the audited financial report. You want to have due diligence report, financial, legal, environmental, commercial, etc. You want to have the approval from the investment committee. You want to have the approval of the investment by the company shareholder. So all these things are going to take time. So look at this list and use this list whenever you're going to go through it, because this, either when you write your term sheets or when you are investing in a company and you have it. So this is it's a good list. It's a comprehensive list on it. And this is typically what you will find in any term sheet that you will get. So I'm not going to go through each of the elements. They're fairly clear in terms of what is required. It takes time. This is what due diligence is all about. The due diligence Rassan took place is going through these and validating what these are well done. Are there any question marks on those? Do we want to change some of these projections, etc.? So this is the information that you need to provide. Then there is the phase on liquidity events. Now this is probably the most important of the phases. This is when you need to make sure that you're protected. A liquidity event is an event where all shareholders, all investors are going to have such a clause. So this clause here is when is the investor going to take his money out of the company and at which rate he will take the money out or she will take the money out of the company. So the liquidity event, and these investors want to have the liquidity events clear in your mind and in their mind before even we sign a shareholder agreement. So in the term sheet. Now, when they list it, they have, so the intention of the parties is for the investor to be provided with the opportunity to sell its entire equity interest in the company through one or a combination of the following events, each liquidity event, as soon as economically practical and desirable for the investor, but in no event later than 6 years. Now, why did he set 6 years? Because most VC funds are what we call close-end funds. Close-end means after 6 years or 7 years or 8 years, you have to return the money to the shareholders who have invested in your fund. So this forces you to have a timing on it. And in this case, he put 6 years, which is typical. I would say 5 to 7 years. It could go up to 8 years. So the 6 years for me, I have no problem. Now, what's interesting is the two elements. The first thing, at the request of the investor, after the specified date, the company will use all the reasonable commercial efforts, including the appointment of a reputable regional or international investment bank to assist the investor in selling its remaining stake. Okay, this is fine. We have no problem with this at the request of the investor. The put option. The put option, starting 5 years after the closing, the investor will have the right, but not the obligation, to require the sponsor to purchase all. Sponsors means what? Means the initial shareholders, mean the owner, to purchase all or parts of its share for cash at a multiple of 6 times the company EBITDA. For this purpose, the company EBITDA, remember initially it was evaluated at 4 times, now it's 6 times. But what is most important is the next sentence. For this purpose, the company's EBITDA will be defined as the higher of that as shown on the company's 5-year audited income statements. So we will see what happened in terms of the audited income statement and the year 5 forecast in the company's approved business plan. So today we have a projection, and remember those projections. The projections are extremely ambitious because of these projections, we come up with a valuation that is higher. So in this case, what is the investor saying? He's locking you in at 6 times either the actual EBITDA that you've done in year 5 or the forecasted EBITDA. So, and the forecasted EBITDA is probably very aggressive on this case. So he is not taking any risk. On the convertible side, he's asking you to come up with the interest payment plus 2.5 times the interest. And on the convertibility, on the liquidity events, he's asking you to commit to buy you out at 5 times your either projected or your actual, whichever is higher. Okay, so this is important for you to understand on it, and you will have such similar clauses in term sheets. So it's important. I'm going quickly through it, but it's important, and then we will go and discuss it. Board representation, this is typical. So you will need to have, the board should meet quarterly. You have 1 seat or 2 seats, depending on your shareholder position. This is typical, and you should ask. If you're an investor, it's important to ask. And even if you're the company founder, ask for it. Because this is where you would value the company contribution. Is not only in the cash, but also in the quality interaction that you have during these board meetings. So the board of directors is quite important, and you will have it in all term sheets. You will have it. Key appointments. This is specified. Normally it's on what I called reserved matters, but here they've put it as a separate clause. They've put the key appointments, mean the investor's affirmative consent is required for the appointment of CEO, COO, CFO, Chief Marketing Officer, Company Secretary, External Auditor, and other senior management positions in the company throughout the duration of the fund's investment. The investor and sponsor agree to jointly recruit for these and that may be. So what it means that you're not the only captain on board. It means that the investor has the right of refusal for all the key positions that you will have in your organization. So make sure that you understand, and this you will find, maybe not as extensive as this one, but definitely the CEO and definitely the CFO. These are the two most important decisions that needs to have. Now we have the fees. Remember, 11.5% interest. You remember this. This is annually. On top of this, 1% commitment fee payable upon signing the transaction documents. 1% monitoring fee payable upon signing the transaction document, and subsequently shall be paid annually in advance of the anniversary of the transaction. So you end up paying 1% upfront. You end up paying 1% over the next 5 or 6 years. I forgot the term. There were 5 years. So this is an additional 5%, and 1% renewable fee payable annually in advance of the. So what you end up paying, 11.5% in terms of interest. Remember, 1% upfront fee, which is fine. I don't have a concern. I would negotiate it to 0.5%. And then you have 1% monitoring and 1% renewable fee. So this is 2% annually over a period of 5 years. This is an additional 10%. So 11.5% plus 10% paid 2% of the value of the transaction on an annual basis. So this is a real case. Huh? I'm not exaggerating. I'm not putting, this is a real case. Emmanuel is on the call. We went through it, and then we had it. So then we go to management and protective rights. So long as the investor holds an investment security of the company, i.e. as long as the company will not take certain decisions without prior approval of the investor. These are the reserve matters. A list of these decisions, this is the reserve matter that I meant, will be specified in the subscription agreement and will include, among others, the following: payment of dividends, approval of annual expenditure, the budget, the incurring of any aggregate indebtedness if you are trying to raise debt. So he specifies these are the reserve matters. Now you need to know what these reserve matters are. These are the matters that you will have to try to fight because you don't want to be to have an investor who is here and who is hammering you in micromanagement for very small details that you have to that you will have agreed to in your reserve matter list. Okay, so this is important. This is complement to what I showed you initially in terms of the key appointment. Information rights. So this is your obligation to provide as information. So long as the investors hold investment securities of the company, it will deliver to the investors for the company and the subsidiary. This is the list. So you need to make sure that you have the systems, that you have the people, that you have the knowledge to be able to provide all these documents. Within 45 days at the end of each fiscal year, within 30 days at the end of each fiscal quarter. You know, so we have narrative business report, unaudited quarterly financial statement describing the company's progress during the quarter. This is fine. This is normally what you need to be comfortable with. So either as an investor or as the owner of the company, you need to know these level, and you need to provide this information to the investor. I think it's his right or her right to do this. So you have here the list. Look at it. Make sure that you have the expertise, make sure that you have the knowledge to be able to do this. And if you have questions on these things, come back to me. And this you will see information right in every single one of these term sheets. Down round protection. I've mentioned it. This is where you put anti-dilution. Here it's called down round. What is a down round? Let's say that we go with Clean 2.0. Let's say we agreed on a valuation of 1.5. Let's say that in 2 years down the road, Clean 2.0 find another investor, but the investor is only willing to invest at a valuation of 1 million. So 1 million means for us, we were at 1.5, we have a down round. Down round means the valuation in the next equity round is lower than the valuation in the previous round. Now in the down round, what he's asking here as the investor is basically he wants to keep the same shareholding position that he wants. So he's asking the owner to issue new shares for him or her in order to be able to compensate for the lower valuation that comes in. So this is what we call anti-dilution or down round protection. And this, a lot of investors will push for it. And this is where you have to push back like crazy. Because what it means that you will be further diluted. He's not taking the dilution risk with you. He is trying to protect himself on the dilution if there is a down round. And in Lebanon in these days, but even in Africa and across the world, there is a lot of down round because of the recession taking place. So don't expect that your next equity round will be at a higher valuation. It might very well be at a lower valuation, i.e. we have a down round. And normally on down round, everybody should take the same bite. But in this, with this clause, it's not. This clause means that you are protected. The investor is trying to be protected in terms of his down round valuation. Now, do you have other compliance? Compliance will be important. So you have different here. It's because it's a manufacturing of food. You have different compliance. So you need to be compliant. You need to be clean. Legally, you need to be clean. Tax, you need to be clean. We don't want to have any skeleton. It's this sort of post-closing covenants that you have are completely acceptable. Investor preemptive rights. So here you have the shall have a pro rata right, but not obligation based on its percentage equity to participate in any subsequent issue. And this is fine. This is fine. You have the right to participate on it. You have the right to so the investor tag along, which is number 15, we also discussed it in the previous one. So the investor have the rights, but not the obligation to sell its common shares, to sell its equity position on a pro rata basis and on the certain terms and condition if any of the existing shareholders sell to share. So this is fine. There is no problem with it. Investor right of first refusal. The investors have the right of first refusal with respect to any share sold by any of the existing shareholders. This is careful. This is important. Here, what you're saying is that I, an investor, if you want to sell some of your share as the founder, I have the right to say no. With respect, the right of first refusal with respect to any share sold by any of the existing shareholders. Careful on this one, because you might want to have liquidity events personally. Here, this clause will preempt you to do it. Now, this is another clause that you have to pay attention, exclusivity clause. Now, why is this important? Now, this means that once signed, the preliminary term sheet will remain in effect for a period of 180 days. This is the exclusivity period. This is the only, if you want, I said it's a non-binding. This makes it binding. This clause here is binding, and 180 days is for me unacceptable. It means for 180 days, you will not have the right to be able to entertain discussion or to discuss potential term sheet with any other investors. This investor is killing you. Normally it's 30 days, 60 days. If you want to stretch it, it's 90 days. No way would I expect 180 days in terms of this exclusivity. Okay, so we go through and then we have ordinary cause. These are fine. So this is fairly straightforward. Confidentiality, fairly straightforward. Legal obligation, also in terms of straightforward. Other terms, this is clear. Applicable law, you will have, depending what you have in this case here, they use the place of arbitration shall be London, England. A lot of companies, this is Nigeria, but Ghana, they would, if you want to have it as internationally, the rules of arbitration of the International Chamber of Commerce, and then you have the arbitration shall be, well, in this case, London, but you could choose the country where you believe your rights are protected. Expense reimbursements, this is where you agree how much you're going to share. And typically 50-50 is acceptable. A lot of investors is asking you to absorb 100% of cost of legal, financial, environmental, business. I tell you, some of these reports are expensive. To do financial due diligence, to do legal due diligence, to do environmental due diligence. It could be $10,000, $20,000, $30,000 a piece, depending on it. So you have to be on it. So including reasonable fees and expenses of the investor counsel up to $50,000. Such fee will be paid directly by the companies to the advisors. Okay, so this you need to be careful how you want to share it and what will be the overall bill. And then you have the signature of the difference. Okay, I went quickly through it. I went quickly. I think it's a great term sheet. Great in terms of case study, but also great in terms of the content that it has. And a number of the content is something that you need to keep in mind. And this is the most typical one that you have. So I'm going to stop at this point and I'm going to take your questions before we start criticizing it. I've asked you 4 questions. I said, what are the clauses that you will accept? What are the clauses that you will not accept? Why you don't accept them, and how do you go about negotiating them? But before we go into these questions, any questions on the content? So we have, what are the clauses in the term sheet that you will support? What are the clauses in the term sheet that you will not accept? Okay, these are the questions. Thank you, Charvet. So we have those on the chat that you have. These are the questions. Now, do you have any questions to me in terms of specific, before we go into getting your feedback on this term sheet? Any questions? Okay, so no questions. So let me then. So you've seen it, you read it. For those of you who haven't read it, I went through it on it, and I've in some ways shared a bit my I should have been more neutral.
Constantin?
Yes, Sabah.
Just a quick question. Usually
Yes.
the term sheet is written by the investor, right?
It's actually written by the investor, but it needs to be negotiated with the company owner. But it's proposed by the investor. Yes, you're right. It's proposed by the investor, but to be discussed as a matter, like we're going to discuss it now. So I'm going to play the investor, and you're going to play the fund.
I have another question. Since it's coming from the investor, I would assume that the investor would ask for too much so that depending on the negotiation with the founders, he can go down. Is this how it goes?
Absolutely. So this is a typical negotiation, like when you buy a car or when you buy a piece of land, but it's the only way you go with a lower value on it. So this is you're right. This is the first pass. In the first pass, you're going to have a number of what I call buffer, and your role is to be aware what are those buffer, and you have to deflate these buffer as much as possible, one after the other. So yes, you're right. So this is presented by the VC with the VC interest in mind that you have together. Okay, any other questions? Convertible debt terms are very hard for the company. Yes, you're right, Hassan. We're going to go to those. So let's now start at the, let's start maybe to keep it simple. What are the clauses that you feel are the difficult clauses? You know, so what are the clauses that you would like to basically want to negotiate? So I'm leaving it up to you. So please share what are the clauses that you feel we want to go and negotiate better.
I can suggest, Constantin.
Yes.
I think because I took some notes, so I think 9, 10, 11, 12, and 16, and 17 for in terms of days.
Okay. So we have here about 6 clauses that came up. Any other feedback? We will go through all these 6 clauses. Any other ones that you want to raise? Okay, so let me go through it, and I will give you. I'm going to play now not the role of the VC. I'm going to play the role of the owner. So with Sabah, will play the owner of the. 1 is clear. 2 is clear. No problem. 3, it's clear. So we have the 3. It's not clear. I would push back. I will say I disagree on the valuation. I think we need to do the valuation. The equity shares, I will not do it upfront. I will push back on the equity share or equity injections, looking at my cash flow to the second phase. So in 2 years or 3 years, I will try to increase the amount of convertible debt and reduce the amount of equity share and have the valuation of the company not set now, but set in 2 or 3 years down the road, because I know it's going to be higher. So I will push back on clause 3. I will push back on the timing, and I will push back on the valuation. So this is important for you to note. Okay, so this is on clause 3. Clause 4, completely unacceptable. Clause 4, if I go into it, clause 4 is a killer, like Hassan has pointed out. You have clause 4, remember, it's $1 million convertible debt, 11.5% interest. This is US dollar. This is not local currency. So you have the devaluation of the CD, which is very high, about 30%, let's say 20 to 30% per year. This is in US dollar payable back. Typical rates that you will have on USD will be around the 8%, especially if you have collaterals behind it. So what you do, so the 11.5 is on the high side. But what is more concerning is the redemption amount. The redemption amount is a complete no-no. So 2.5 times the face value in terms of redemption amount is no way acceptable. It's 1 time should be, so we pay back the 1 million and we pay back the interest period. So there is, I will push back on the redemption amount. This is what I call liquidation preference, and not have it at 1 time, not at 2.5 times. Okay, so this will be. On the convertibility, which is also this clause, I will completely push back on the valuation. The valuation here at 4 times EBITDA, I would say let's align it. We will align it to the EBITDA when we have the liquidity events. So if it's 6 times over there, it should be 6 times over here. There needs to be alignment. And I will not go for the average. I will go for a multiple of the EBITDA. I will go not at the average of the past 3 years, and not at the average with the book value. I would remove the book value from this. I would say the book value is not at all a representation of the valuation of the company. I will put it at maybe 6 or 8 times EBITDA, and I'll put it not over an average of 3 years. I'll look at the value at the most. So I would look at it, no, actually I would leave it 3 years because you might have some good years and some bad years. But I will change the multiple and I would remove the book value. So this one clause here, I will definitely work at changing. So this is important. So clause 4 is also needs to be included. Clause 3, as I told you, will have to be changed. So 3 and 4 needs to be changed. 5, I have no problem with 5. So this is the data you could go, you could discuss, but this is fine. This is a good list that you have. Remember this list and make sure that you can understand each terms of these lists. The liquidity events is the most critical one. This is the one that you have to push at all costs. So this is the one, especially the put option. The put options to have it based on the 5-year of your projected forecast. This is absolutely no way. So this you have to push back, and it needs, if you have to put it at 6 times, but put it at the average of the EBITDA for the past 3 years, or put it at the EBITDA of the of year 5. So you could find out where, depending on your level of confidence, that you will need these numbers. But you will have to remove the 5-year forecast from it, because with the 5-year forecast, he's guaranteed of his return no matter what, and this is not acceptable. So clause 6 needs also to be changed. So you have board of directors, this is fine. The key appointments, I would reduce the number. I will have it maybe 2, the CEO and the CFO. The rest should be, you could, the fee is completely unacceptable. The upfront fee, 0.5% would be fine. Monitoring fee, 1% per year. Renewable fee, 1% per year. No way would I go for it. So we will go for 0.5%. We might go for another 0.5% in terms of overall fee that you get on it. But to have annual fees, try to negotiate them down to about 0.25%. So this here is another killer in terms of expenses that builds in. So this I will push back on 9, like have been raised by our friend Sabah. 10 is what you do is your protective right that you have. You need to make sure that you have your list. This is very important. What are the reserve matters? Look down at every single one of them and trying to understand, does it make sense or it doesn't make sense to run your company? Because if it's going to intervene with how you run your company, it doesn't make sense. The information rights, the 11, this you need to look at it. You will always have some sort of information right. Make sure that you could deliver. Make sure that you have the system, as I said, and the people that you could done it. The down run protection, push it back. This you push back. You don't accept. You don't want to have an anti-dilution. Now, if you have no other investors, you might be forced to. And I know some investors, I won't mention names, that are forcing it down to the throat because nobody else is going to invest in the company. And this could be, so as you can, this is why it's important for you to get at least 1 or 2 investors to be able to get some sort of negotiation with it. So down round protection or anti-dilution, push it back whenever you can. Your 13, this is fine. You need to make sure you're compliant. Your preventive rights, this is fine that we have. Investor tag-along, in this case, is fine. Right of first refusal, be careful on 16. Be careful. So if you have liquidity events that you want and this will be blocked, this is important that you push back if you can. And the exclusivity period, no way, 6 months, no way, it kills you. It kills you and it would lose interest of any other investors. 60 days, 30 to 60 days that you have to have. And the rest is fine. So thank you, Sabah. You mentioned it, 16, 17. This, keep it, use it, sleep on it, review it when you have a term sheet to go through it. Come back to me with your questions. You know, we will have the one-on-ones. I had, after the valuation, company valuation, we had 8. I have one of you have voluntarily come and would co-deliver those with me. Actually, he will run it. So this is one also coach that will be doing it. And we're going to have these one-on-ones also for those of you who are interested after this workshop. Will schedule time, typically half an hour or an hour, to go through whatever questions you have or whatever discussion element you have. So this is on the term sheet. Let me look at your questions to see whether I missed anyone. Will it be shared? Yes, it will be shared. George, so let me go through. Rassan Kozak, convertible debt terms are very hard for the company. Absolutely, Rassan, completely right. Salwa, is this term sheet produced by a company or the investor? It's produced by the investor. So it's the investor that produces it, but you need to sign it. So you need to know what you sign it. So you have to push back. George, company liabilities, if possible, to review the best terms to negotiate the anti-dilution clause. Okay, so this we could do this on a private basis. I'm sorry, I shouldn't have mentioned Didier also on a private basis. It would be interesting to take this example and work on a simulation and compare it. Okay, this we could do, Didier. It's absolutely correct, because if I take just the example of the convertible debt, to keep it simple, if I take the convertible debt and I say, okay, I'm investing 100 or $1 million. I'm investing $1 million. I'm getting 11.5% in terms of annual interest per year. They're asking us for 2% and top in terms of other fees. Remember, so the 11.5 is not 11.5, it's 13.5. So we have 13.5. You have 1% that are asking upfront. So this is like, let's say 0.2%. So this is 13.7. So we're now at 13.7. And the most scary thing is, of course, I'm having one, and I'm going to get to 2.5 times the 1 million becomes $2.5 million on it. So this means that you have the 2.5. So this is in terms of additional interest. So normally it should be 1. We talk about 2.5 times. So this is equivalent to probably about 20%, maybe actually 20% per year. I don't have the my 12C with me, but let's say about 20%. So in total, what we're saying is if you put at the fees, include the fees, if you include the interest rate, and if you include the term at which he wants to, the redemption amount, we're talking about 35% to 40%. So his actual return just on the convertible debt is about 35 to 40% return. If you put his return based on the equity, it will be another amount. So the cost of this debt becomes phenomenally high. So this is quite important for you to understand on this. So we could run the examples on it and I could share it with you, but I've run it now on the back. I'm going to stop at this point, see whether there is any questions. I'm going to ask Rassan to share with us his learning that he came, Shabid, I'm taking the, will it be shared? Yes, it will be shared. Don't you think that giving the investor the right to appoint employee is not good to the company because he will prefer to? Yes, you're absolutely right, Shabir. So this is why you need to be important that you negotiate this tightly. Now, for the CFO, I'll be very frank. It's going to be very difficult for you because I want to make sure as an investor that I have a CFO that I can trust on it. So it's going to be a shared decision. And ideally, if there is any other shareholders, like it's a shared decision. And if you disagree on those, it means that we might have a tough time. And do I want him as an investor if we have disagreement in terms of who is the best people to hire for the company? So keep this in mind. I think it's an important quote. Questions before I pass on to Rassan? Okay, so let me check chat. Was it this? Was this wise to propose from the investor? Okay, frankly, Antoine, this is not a good. I mean, this in some ways, and I don't know if Emmanuel is still on the call or not. But when I looked at it, and I looked at Emmanuel, and I said, Emmanuel, look, these guys are crazy. You know, how can they could? This is an established, it's a well-known venture capital firm. To present this case is reflecting badly on the image of the VC. You know, but if you are the only one and there is no other VCs, and at the time, this was 5 years ago, VCs activity in West Africa was non-existent. So you could come up and set the conditions that you want. In this case, of course, we suggested that not to follow it, and it was not followed. And we actually even came back and we said to the investors, look, you need to, if you want to work with Stanford seed companies in terms of a potential investor in these deals, you really need to change some of your clauses, make them more of a win-win and less of a one-directional. Okay, it is caring for the business, absolutely. Okay, I'm going to stop at this point. Ghassan, if you're still on, can you share with us the findings that we went through with the Clean 2.0 due diligence? If you could unmute yourself, it would be great. Ghassan will be followed by Ziad Sankare. Ziad is the owner of Cardio Diagnostics. He went through 2 equity rounds with different term sheet that he has to, and I'm asking him also to share his expertise from it. So Ghassan, the floor is yours. Thank you.
Thank you, Constantin. Hello, everyone. Thank you, Constantin, for putting me on the spot. I wish you had given me a bit of advance notice. So I'm going to give you my thoughts on the due diligence that I did with the rest of the team, including Constantin for Cedars. I'm going to give you my thoughts as they come. They're not necessarily in any particular order. I think the most important thing for me was to establish trust with Clean 2.0. I offered immediately to sign a non-disclosure agreement for them. I made it very clear that trust was needed because, one, I'm not the enemy. The investment, the funds that they're looking for are a lifeline for them. And at the same time, there's the possibility that the deal could be a very good deal for Cedars. So the whole negotiation had to be based on trust and on good faith. And it was. I was very happy to have the whole support of the due diligence team. I wasn't the only one looking at Clean 2.0, and that support was crucial. We had a timeline, a time limit of 6 weeks to do it, and it's important because you can keep on looking and looking and looking, and it's important to have a date by which you have to return the results. We looked at several things. Essentially, we looked at what could be the major obstacles, the major deal breakers. Every time there was an obstacle that was found, we had to look at the fact at whether there was or not a mitigation plan in place. We looked at the team, how good they were. We looked at the product that they were offering. Was it innovative? At what stage was it? Was it the MVP? Was it already being sold and so on? We looked at the size of the market, at the marketing plan, at the branding. We looked at the investors, and here Clean 2.0 had already obtained a grant from Bada'il. They had flat 6 labs that had invested with them, and were willing to invest even more and match the Cedars investment. And that was a lot of reassurance for us. We looked at where the company was. We looked at the intellectual properties, what kind of protections they had. The big lesson for me was looking at the numbers. The prior evaluations that I had done before were always for existing companies, where I had 5 years of past returns, past activities, and so on. Here, in the case of a startup, you have to look at the future, and you don't have much of a basis to rely on. So the financial projections are going to be a lot looser than what I expected. And it was quite an adjustment for me. The purpose, of course, was to evaluate the risk and to decide to go with a decision to invest or not within the company. I did not look at the valuation at all. That was not part of the due diligence that was done. But because we had because we had established trust, they were asking for 1.5 to 1.7 million, and they were ready to accept the idea that the valuation would come a lot lower. And again, it was because trust was there. On the other hand, if trust is there, they could also convince you that the price you're offering is too low. So it's something that works both ways. Finally, from a personal point of view, over the years, I was responsible for many investments. Some of them lost money for the investors. And for me, it was absolutely something that I wanted to avoid. So I did the best due diligence I could do with a sense of strong responsibility, if you want, a fiduciary responsibility towards seeders.
Hassan, thank you. Thank you very much. It's and I know Hassan and I are old friends. You know, we know each other for I won't mention the number of years, but more than 55 years. So this is why I took the liberty with him that I will never do with any of you, in terms of putting him on the spot, because I knew that he was going to deliver extremely well. Hassan, any other points before I open up to questions of the team? Do you want to share any other learnings from the process?
Well, as a learning, it was a big learning experience for me, simply because of the loose numbers. You're dealing with projections, you're not dealing with existing sales. So somehow you have to relax a little bit more what you expect out of the projections.
Very good. Any questions to Hassan? You just unmute yourself if you have the question to ask. This is on the due diligence process. We will get the results. And he has done a great, the due diligence report was excellent. It was best in class that he has completed. So if in case any one of you are interested in going through due diligence, you want to reach out to Hassan, myself, or any of the CEDA members, we'll be happy to share with you the process that we use. So there is a question. Thank you, Hassan. Okay, Rabia. Thanks, Rabia. Rabia, by the way, is going to is the one who is organizing the one-on-ones that we have following the company evaluation, and he's also have the breadth of experience in terms of the ecosystem that we have. Hassan, thank you so much. You know, we could hear the birds in your background, and since I'm facing the church, you're going to hear the ring bells here. So this is part of the Zoom. Very good. I'm going to mute myself. Before I mute myself, it is Ziad is also on the call. I'm going to introduce Ziad. Ziad is the founder of Cardio Diagnostics. A number of you know Ziad. This is one of the first companies that received funding from Berytech Fund 1. This was more than 5-6 years ago. He managed to get a second equity round with another VC player in the Lebanese ecosystem on it, and so he has what I call a big chunk of experience in terms of negotiating term sheet, and I asked him to share the best practice and maybe some of the key challenges that he has faced. So Ziad, if you could unmute, I will mute myself, and it would be great. I'll leave the floor to you. Thank you, Ziad, for joining us, and it's a pleasure always welcoming you and working with you over the past 5 years. Thank you.
Sure. Thank you very much, Constantin, for the opportunity to be here and to talk to your audience. So as Constantin briefly introduced what I've done, I've raised equity on 2 different rounds. The first one was back in 2013, when we raised $540,000 from Berytech Fund 1 for my company called Cardio Diagnostics. At the time, there wasn't much for the company beyond a proof of concept prototype and some R&D that I have done over the years. And the company was valued at around $1 million. And for the $540,000, Berytech kept roughly around 1/3 of the company. At the time, I was around 25. I wasn't really experienced in raising money. So there was a lot of things that were not truly clear to me in terms of how the term sheet is negotiated, how the shareholder agreement is assessed. I did seek the help of an advisor in the US in my network, and the feedback was minimal. There wasn't much negotiated in the term sheets, and at the time, everything in the term sheet and the shareholder agreement seemed logical in terms of what it entails. There were around 36 restrictions or reserved matters in the term sheet. Many experts later, when they look at the term sheet, thought it's a very aggressive and entrepreneur unfriendly term sheet. And I only realized the challenges that come into this later in life. Particularly, I'll give you a few examples. For example, the term sheet prohibits any spending above $10,000 from the investment money without the written signature of the investor. And keep in mind, investors in the Middle East and Lebanon and usually tend to be not the most available and the most proactive. Of course, we're not generalizing, but I've seen a majority of entrepreneurs highlighting that they haven't been able to access their investors readily. So when you're a small company, $10,000 seems like a lot of money. So you don't mind waiting for a signature, a second signature, when you want to spend the $11,000. But later when the company grows and your transactions are in the 6 and 7 digit numbers, this becomes a real hassle. For example, today, our smaller transactions are above $10,000. And it becomes a real hassle to find the distributor and to find the investor and get their signature on each one of those. So those are examples of things that become later inconvenient. Another example is I had to sign that anybody whose annual salary is above $5,000, so we're talking about the driver and upwards, have to get a written approval for you to be able to hire them. And in that case, at the beginning, it doesn't matter because you're going to hire a few engineers and few business people with yourself. But later on, when it becomes a more established company with maturity and with the need to hire and fire and handle turnover of employees and fast turnover, sometimes it becomes really a hassle for you to chase your investor after each hiring and firing that you want to do. So those are some of the examples that I learned from the first term sheet. Some of them have been changed. Other rules in the term sheet remain, and they continue to be an operational trouble for the company. And this is where I would give the strong recommendation to really understand what you're signing, because sometimes the language might be not as clear to young entrepreneurs or to novice entrepreneurs when it comes to their first time or second time in the endeavor. It's important for you to really get an expert and have them explain to you what you are committing yourself to, because this might be way beyond a year or 2 year commitment. For me, it has been a 7-year marriage, and it comes with its own challenges when you sign things that make sense at the beginning, and as things progress, they start becoming a burden. For the second term sheet, I raised $1.5 million from Cedar Mundi. That second term sheet, I employed many of the learnings I did in the first one. So it was much better negotiated. I consulted a lawyer in the United States, and he explained to me the terms, what's tag along, what's drag along rights, what are the liquidation preferences. And it took actually around a year to negotiate, mainly because of malalignment between the previous investors and the new coming investors. The new coming investors wanted to lock everybody in for 5 years. The previous investors have stayed around 4 years by that time, and they wanted to exit at an opportunity that is feasible. So it took them a lot of time to come to terms on this. And it doesn't also help that some of the investors do not reside in Lebanon. So their meetings were sporadic, once a month or once every other month. So things also take a lot of time when the investor's base is not really in a geographic proximity, or when they're not accessible. In the second term sheet, the only problem I faced is that it turns out there was a hidden language that my lawyer in the US did not really point my attention to. And it was referencing the trade law of Lebanon, Article 158. And I think that's my mistake. I didn't look into a Lebanese lawyer or look into what Article 158 mandates. It turns out it puts a lot of restrictions on me as a majority owner and the founder on what I can and cannot do without the approval of the new investor. So I ended up with also a new set of restrictions that are kind of, in my opinion, inconvenient, but they were definitely different set of restrictions that I learned from the first term sheet, and I was able to handle it accordingly. A small note here that I empathize a lot with investors now that I've been part of the Cedars investors group, and I understand the mindset when you sit on the other side of the table. And I also think that the ecosystem as a whole has been maturing over the years and has shown signs of entrepreneur friendliness. And I strongly believe that this is a trend that has to continue, because it only works when the sides are aligned. And this doesn't seem to be a skill in the Lebanese society to create a win-win situation. I've heard it from multiple ministers and decision makers that the Lebanese society in general and the culture in general is not a team player. It's a solo player type of culture. So coming together to form a company or to form an organization is not an easy thing given the culture, and finding win-win situations and creating the right incentives for different stakeholders is a challenge by itself. So I see that today there have been a lot of learnings from my side on both as an investee and entrepreneur and as someone who sits on the other side of the table. And I think that the ecosystem continues to learn and mature and improve over the years. Happy to take your questions if you have any.
Thank you, Ziad. The floor is open to questions. So we have questions coming in.
Can we ask verbally or should we type in?
Go ahead. Go ahead.
Yes, thanks, Ziad. I mean, that was very inspiring what you said. I have a question for you and maybe also to Constantin. Does it happen that the term sheet reservations are renegotiated during the term of the investment? Because as you said, like what seemed very easy for you and not a problem at the beginning slowly became, I mean, really an operational nightmare. So is it like, does it happen that you renegotiate over time some of the clauses that prevent the good functioning of the company?
Ziad would have wished that was the case on it. Unfortunately, when it's signed, it's signed. So you might, on an exceptional basis, be able to renegotiate. Refresh my mind, Ziad, were you able to renegotiate some of these clauses?
So the 2 points I highlighted, I did renegotiate them and change them. So now the limit is no more 10,000, it's in the 50,000 to get a signature above which. And for employees, I have the ability to hire and fire finally. I'm talking about that happened around 2 to 3 years ago. So those were things that were negotiated. I came to the board with 12 items out of the 36 that I wanted to reconsider, but Berytech were not open to reconsidering those. So there are certain things that you may be able to negotiate, and there are other things that the other party would oblige you by law and would keep things the way they are. So I was able to fix certain things, but other things continue to be open and unfixable.
Other questions? Now, I have to state for the record that I was not the one negotiating the term sheet with Ziad. So I got to know Ziad. I was in the investment committee that approved Ziad's case, but the term sheet was negotiated by the general manager for Berytech Fund 1 on it. And I was more helping Ziad and the Berytech find areas of close collaboration in it. So, so I was not sitting on the other side of the table. I was recommending the evaluation and trying to add value wherever we can to help him scale.
True.
Any questions to Ziad before we thank him? Very good. Look, I on purpose asked him to come because I know how much he went through in terms of challenges, and a lot of his time, unfortunately, was spent on trying to convince the shareholders to renegotiate the clauses. And this takes time away, and it's basically a lose-lose situation, because instead of focusing on building and growing, although he's doing it, but a significant portion of his time went in trying to renegotiate why these clauses have to be changed and why is it hindering the business. So very important that you're aware of it, and also feel free, as Ziad, like myself, we're completely open to provide you with our feedback whenever you're going to face with a similar situation with a potential investor, either you being the founder receiving the funds or you being the investor negotiating the funds. And Ziad had the case to be on both sides of the table, because not only he received funds, he was also part of Cedar, and he was investing in different companies and also conducting the due diligence that Hassan has shared with you. Ziad, thank you. Ramadan Kareem to you and to the team. Thank you again for being available. Wallah yatik al-Fati.
Thank you, and to you and to your audience. Thank you very much.
Very good. Now we're going to the closing phase. What I want to do is I want to be able to share with you some of the learnings. So let me go through. This is the slides which were shared last time. So you will all of you will get these copy of the slides as soon as you you complete the evaluation form. Now on the evaluation form, make sure that you also indicate if you are interested in having one-on-one discussions, because I know some of these terms are very confidential and very private in nature, and you don't want to share it with a big crowd. Feel free to do so. We do this. This is part of the services that we offer. We'll be happy to do this on a free of charge basis, of course, that we do. The other thing is also mention if there are other topics that you'll be interested in getting webinars. We have touched several of those. These are the term sheet and the due diligence one are very very technical. We also covered company valuation. We will be covering risk management. We have it here actually. I'm sorry. It's not. So let me share with you the takeaway. Okay, first on the negotiation process, I'm going to, although I went through quickly last time, I want to go through it. You will see an overlap with the next two slides. Get more than one investor on board. So don't talk to only one person. If you talk to one, in some ways, it's a monopolistic situation. So the person would know that he's the only one or she's the only one, and will try to negotiate a term sheet that might not be as advantageous to you. So always try to get a couple, if not three. So what you do is you talk to several of those, and then select the one that you think are most likely to fund and most likely to add value. The second one is the one that Ziad mentioned is you need to understand the typical clauses. You understand the drawback for each of these clauses. You need to understand what are, so you need to get together. And this, I provide you with the first overview. You have books written on it. I don't want to turn you into lawyers, but at least understand the commercial and financial impact of the clauses that you sign. This is important, and we went through it this time and last time. The third one is the valuation. You would need to be on top of it. You know, how do you push back? Here they valued it at $4 million. Is this the right valuation or not? What is the base of the valuation? And whether you want to push back on it or not. This is quite important for you to, and go back. Each of these webinars are taped. So you could go back to the one on company valuation. It was about 3 hours on it. Joel is on the call with me today. Joel also is here to help you to validate your valuation model. I'll be more than happy to go also through it and make sure that you're on top of it and ready to negotiate it and to discuss it and to defend it with the investor. So point number 4, get yourself a financial and legal advisor. Don't try to do it alone. You heard it from Ziad. He even went to the US, got help from the US. He paid for this help, but hopefully it added value to him in this. So get yourself advisors. And the 5th point is you need to look. He had his list. This is afterwards. it would be, he had the list of, he mentioned, I forgot how many, 12 clauses that he wanted to change. He got 2 of the 12. Now, these 12, if he knew initially, he probably would have put it as the non-negotiable. So it's important that you understand what is non-negotiable for you upfront, and talk to other investors, talk to other people who received investment negotiated term sheet, like Ziad. You have more than 200 companies who received investments in the ecosystem in Lebanon. So make sure that you talk to, and I'm sure you know several of them. What are the negotiables? What are the non-negotiables on it? What you will never it's deal breaker. So what are these deal breakers? List them and defend them. Number 6, understand the dilution. Ziad went through 2 rounds. You most probably, any company, if you do well, you go for 4, 5, maybe even 6 rounds. Each of these 6 rounds, you will have dilution taking place, unless you have anti-dilution. But the anti-dilution that other investors are putting are going to dilute you even more. So this is why you have to push back on the anti-dilution clauses that you need. So you need to know what this impact is going to be. You need to forecast it. You need to see, look, this is going to be my revenue. And I know, and this is going to be my profitability over the next 5 years or 6 years. This is most probably going to be my valuation range in 2 years, in 4 years, in 6 years, in 8 years. This is what my shareholding position is today. And it's very easy to see how your forecasted shareholding position is going to evolve as you go through these different rounds. So what you need is, you need to have a projections of how many rounds you need, how much money you think you're going to raise per round. What do you think your revenue and hence associated with it is your valuation going to be? And what will be your dilution impact? Do this model. If you don't know how to do it, we will do it with you. So this is quite important that you understand it, because we don't want you to end up with 2% shareholding position when you have put all your blood, time, effort, sacrifices in this company. So important that you do this. Point number 6. Point number 7, you take the control of the negotiation process, not your lawyer, not your financial advisor. It's your future, it's your investments, it's your blood and sweat, you control it. But make sure that you are well positioned to defend it. If not, it's going to be a problem. And last is the due diligence is still not committal. The due diligence, the term sheet negotiation, it's not committal. The way they ask the questions, the way they go about trying to get alignment with you, and on whether this is a good deal or not a good deal, you're going to learn a lot about the investor. And you might decide, maybe I'm not interested. Maybe this is not the, because once you spend on a regular basis, you know, each one of them, due diligence and term sheet, is about at least a month, if not 2 months, each one of them, you will get to know extremely well your investor. Ask yourself, is this the person that I want to be on board as a shareholder? So make sure that you do this exercise and do it well. Okay, in terms of the learnings, this is more specific. What you do is when you start, and you mentioned, you remember the use of funds. How are you going to use it? Try to come with elements that are here to accelerate or validate the scalability of the business. So invest in what is going to increase your value. Invest in what is going to prove your scalability. This is what you should invest. The nice to have, do it afterwards. Prove to me that you have a model that is working. Prove to me that a model that is scalable. Prove to me that you could really come up and do the revenue growth that you expect. This is very important. You do your own due diligence. It's the last point that I have. The credential of your investor should be thoroughly assessed, not only through his questions, and it's not only how much he's willing to value, it's what is the other value that he's going to add beside the money behind it. Pay attention to liquidity events, that this is what also has been mentioned, and make sure that you are escaping or pushing back on what we call guaranteed exit, like we had in the term sheet. In some ways, they were guaranteeing at year 6 that no matter what happens, it's going to be 6 times your projected or forecasted valuation. This is guaranteed exit. No way you should accept those things. So very important to push back. Negotiate the exclusivity of the to maximum 2 to 3 months. He was asking for 6 months. Push it back. This is a killer also, because it will block you for a long period of time. And you're going to spend a lot of time providing data, providing information, so make sure that this period is as short as possible. Spend time understanding the impact of the list of the reserve matters is all what you have to, all the decisions where you need to refer back to the investor. And those decisions, if it's a long list, you will suffer. Ziad has 12 of those reserve matters that he wanted to change. He succeeded in having 2. So you better know this upfront when you talk and you negotiate and sign on one of those reserve matters. The non-dilution or anti-dilution or down round protection that I've mentioned, push back. Because if you don't push back, it's you who's going to be as initial shareholders and the other shareholders that will be diluted further, because the previous investors will protect his shares. So ensure that you are pushing back on it. The annual fees, I've put 1% upfront and 0.5% on an annual basis. In this case, it was 1% upfront, but it was 2% on an annual basis. It's a killer. So you need to push back on those. Share the due diligence and legal fees. This is important. Watch out for the list of condition precedent to an investment. So the longer is the list, this is how much micromanagement is the investor going to do in your company. So make sure that you're on top of it. Make sure that you're committing on numbers and milestones that are realistic, because the last thing you want is to commit on numbers and then quarter after quarter to fall short out of it. You don't look as somebody who is knowledgeable enough to be able to set objective and metrics that are achievable. So this is, so swallow your ego a bit, go on the conservative side, and especially on the cash flow. Give me measures of cash flow that are important, because the last thing you want to do is to go back to your shareholders every 3 months or 6 months and say, by the way, I was mistaken, my cash flow gaps, I need about $50,000 more or $100,000. You don't look well when you go through this. So set especially cash flow, because this is where you have to go back and ask for more cash. Okay, get at least this I've mentioned and repeated, I should have removed it. Be quick and smart in responding to due diligence requests. You've heard it from Samar. This is how they're going to judge you. If you take time, if you're not sure of the answers, if it's back and forth. So your data room should be well prepared, and we could help you prepare your data room. What are the information that we'll ask? We have a whole list of this data points. Market study, audited financials or financial projections, your business plan, feedback from customers, feedback from employees, the CVs of all the people. So all this, you have questions, the legal, the shareholder agreement that you have, the whatever other legal documents that you have, any mitigation that you have. So all those, this is your data room. Prepare it well so that whenever question comes in, you're quick and you could respond it quite quickly. Debt and equity transaction is for the long term. So make sure that you select the investor for the long term. So the alignment in values, on the priorities, on the exit, liquidation events, this needs to be very clearly understood upfront. Avoid several dilution, severe equity. I've mentioned it again, I won't. Always surround yourself, this I mentioned, competent and trustworthy. Legal, financial are the most important one, but you could have also sales and marketing people. List your drag maker, I mentioned it, and do your homework and compliance. This is important. So these are the key learnings. What time is it now? It's exactly 11:30. Any questions before we close? So this is, I appreciate your time. I thought it was of value to get also a different perspective. So Hassan, thank you. If you're still on the call, Ziad, thank you. We had previous, and every one of those webinars will always get an external perspective. So no questions. Have a wonderful long weekend. Stay safe, and feel free to reach out. So indicate on the evaluation form in case you want to have one-on-ones with it. And we run those workshops anytime. For instance, Mirai here just sent me a message. With USG, we're going to have a session for how you put together your business plan, how you put together your investment teaser. So we're providing it across different institutions, not only USG, we do it with AUB, we do it with LAU, we do it with Balaman. So feel free, this is again the services that we offer to the community. You have your association, we'll be happy to contribute to those. Thank you again, have a wonderful weekend and appreciate your trust. All the best to all of you, thank you.